Hey everyone, welcome back to the Noob Selling Options channel. I am absolutely pumped you're joining me for today's explainer. We are diving deep into the hidden mechanics of market movements. You know, if you've ever felt like the market is just out to get you, like it's specifically hunting down your positions, well, you're definitely in the right place. Today, we're going to decode exactly why the market moves the way it does using some real-time exchange order book data and liquidation heat maps. And then we're going to take all that and apply it directly to the massive battleground currently unfolding right now on the Bitcoin charts.
So, we've all been there, right? You do your technical analysis, you place your trade, you set a totally sensible stop loss just below a major support level, and then, boom! The price violently wicks down, tags your exact stop loss order, kicks you completely out of the trade, and then instantly reverses and rockets off in the direction you originally predicted. It feels so incredibly personal. It literally feels like someone is sitting there watching your account. But the reality? It's not personal at all. It is just pure, unemotional market mechanics at work.
Okay, let's dive into this. Here is our roadmap for today. First, we're looking at the stop-loss trap and why whales actually need market fuel. Second, we'll break down the four-step liquidity sweep. Third, we're taking this to Bitcoin's 78K battleground with real-time data. And finally, the decision zone, so we can map out the market's next high-probability moves.
All right, part one, the stop-loss trap and market fuel. To really understand why price moves, we have to start by looking at what the biggest players actually need. What you're experiencing as a totally frustrating stop-out is actually known in institutional trading reports as a liquidity grab, or a stop hunt. Now, notice that term, counterparty liquidity. According to institutional market-making manuals, these massive players aren't sweeping levels just to make you lose 20 bucks. They're doing it because they structurally require your triggered stop loss to fill their own massive orders. It is strictly the raw mechanics of supply and demand.
Think of it kind of like a David versus Goliath scenario. A retail trader, David, can buy or sell 1 or 2 Bitcoin with a single click, right? The order fills instantly, the broader market doesn't even flinch. But Goliath? Institutions, market makers, whales, they're dealing in tens or hundreds of millions of dollars. If an institution tries to buy that much all at once, there literally won't be enough sellers at the current price. This causes slippage, which basically shoots the price way up while their massive order is only half filled. So to enter a huge buy position without wrecking their own entry price, they need an equally massive pool of sell orders. They need fuel.
And where exactly do they find all that fuel? Well, they find it in your risk management. This is absolutely crucial to understand. If you buy Bitcoin and go long, you're placing a stop loss below the current price to protect your capital. But mechanically speaking, your long stop loss is just a pending market sell order. So if thousands of everyday retail traders all have their stop losses sitting right below a major support level, that specific area mechanically becomes a massive guaranteed pool of sell orders. It's an absolute goldmine for a whale looking to buy.
The thing is, this builds a highly predictable pattern. Retail traders are taught to read charts the exact same way. You pick up a textbook or you watch a tutorial, and what does it tell you? It says, place your stop loss just below major support, just above major resistance, or right past a nice psychological round number. Because our behavior is so incredibly standardized, big players and their automated algorithms know exactly where these massive clusters of liquidity are hiding. They don't even need to see your specific order. They just know human nature. Moving right along to Section 2, the four-step liquidity sweep. Let's look at the exact anatomy of how this trap actually springs.
So there's a really specific sequence of events that plays out during a stop hunt. Step 1 is the breakout. The price naturally drifts, or maybe it's intentionally pushed by heavy selling, just below a major support line. Step 2 is the trigger. All those retail stop losses get hit, unleashing an absolute flood of automated sell orders onto the market, usually paired with a bunch of panic selling. Then, step 3, the absorption. This is the trap right here. Institutional players use this massive flood of retail selling to easily fill their own massive buy orders at a discount. And finally, step 4, the reversal. Since the big players just soaked up all that selling pressure, the market is suddenly exhausted of sellers. The price violently snaps back up in the original direction, leaving everyday traders stopped out and totally left behind.
All right, Section 3, Bitcoin's 78K battleground. Let's dramatically pivot from the theory and actually apply these mechanics to the real-time May 2026 data. Just look at this massive number for a second, $3.1 billion.
Pulling from the latest leverage data from CoinGlass and Binance liquidity heat maps, this is the exact value of leverage long liquidation sitting directly beneath Bitcoin's $78,000 support line. Remember what we just talked about with liquidity sweeps? This $3.1 billion represents an absolute ocean of pending sell orders. It's the ultimate institutional magnet. If the price were to actually break and sustain a move below 78K, it could trigger this entire cluster across all the major exchanges.
Mapping out this data brilliantly illustrates the current battlefield and exactly where the institutional traps are set. That $78,000 mark is functioning as our primary line of defense. If that $3.1 billion trapdoor gives way, the downside risk points to a rapid flush into the 75K to 76K range. But hovering directly above our current support, we've got an immediate CME gap between 78,220 and 78,925. And looking even higher, we have massive upside liquidity squeezed between 80,000 and 83,000. Let's zoom in on those upper targets for a second.
First up, right above our current support, there's a really narrow gap sitting precisely between 78,220 and 78,925, coming straight from the Chicago Mercantile Exchange futures data. Now, in crypto markets, these narrow CME gaps frequently act as short-term liquidity magnets. They naturally draw the price in to sort of fill the empty space before the broader trend resumes. So this makes the upper 78K region a highly natural target for localized pullbacks.
But beyond that CME gap, the market is totally squeezed against another massive pool. While 78K is the key floor, right above current prices is a super dense accumulation of short positions and resting sell-side liquidity. This upside target is gathered heavily between 80,000 and 83,000. And what makes this zone particularly fascinating is that it perfectly aligns with the 200-day exponential moving average. So you get this massive technical confluence for a potential upside sweep.
Which brings us to Section 4, the decision zone. Bitcoin is caught in a highly pressurized space right now, so what are the actual high probability moves?
We are looking at two distinct, immediate scenarios here, based on the liquidity clusters we've mapped out. First, the bullish defense. This relies on buyers successfully defending that 78K to 79K area. If they can absorb the selling pressure without breaking the floor, the next high-probability move is a violent sweep of that upside liquidity, basically hunting those short positions up toward 82,000 to 83,000. On the flip side, we've got the bearish flush. If that 78K floor fails, game over for the longs. That $3.1 billion in liquidations gets triggered, shifting the short-term market bias heavily downward and flushing the price rapidly toward the 75K to 76K range.
Now, top analysts from on-chain data firms like Glassnode are watching this $78,000 floor incredibly closely right now. And here's why. Momentum indicators, specifically the daily RSI, recently flashed overbought signals. When momentum starts to wane like this, the gravitational pull of a $3.1 billion liquidity cluster sitting just below the price becomes significantly stronger and a whole lot harder to resist.
But hey, the crucial point here, perfectly captured by veteran institutional order flow analysts, is this. Price doesn't move just because of indicators. It moves to wherever the orders are. Indicators like the RSI simply give us context. The ultimate driver of price action is the raw, undeniable machinery of supply, demand, and the big players hunting for counterparty liquidity. They are absolutely going to push the price to wherever your stops are hiding.
Which leaves us with a pretty provocative question for you, as a trader trying to navigate all this madness. Are you the hunter, or are you the liquidity? Are you blindly placing your stops in the exact predictable clusters that whales are using for fuel, or are you structuring your trades to anticipate and actually survive these inevitable sweeps?
Understanding this stuff is literally crucial to surviving the market, which is why we break it down for you here. If you found this explainer helpful in mapping out the charts today, do us a huge favor and hit that like button right now. It really helps out the Noob Selling Options channel. And definitely make sure you're subscribed so you never miss our deep dives into market structure. Keep your eyes glued to that $78,000 level, trade smart out there, survive the sweeps, and I will see you in the next explainer.